welcome back to StockSessions.com. Now, we talked about mutual funds, and a mutual fund is a pre-built portfolio for you. You'll pay someone for that service, but it can save a lot of time. It can do well in 401ks, retirement accounts. It can do any number of things, your personal portfolio, whatever you want. The mutual fund can help you if you don't want to do all the work for you. We talked about some drawbacks to mutual funds. There's definitely drawbacks. Let's talk about ETFs, or exchange-traded funds. These solve a lot of problems that mutual funds have. So these aren't really as widely known. People don't know much about ETFs. Maybe they've heard about a mutual fund. An investment advisor would recommend that. They might not talk about ETFs. These are relatively new, at least in terms of financial community. These are new products, and they have a lot of potential, and they're already expanding a lot. So these certainly have a place in your portfolio, especially if you find mutual funds appealing. What is a mutual fund? It's essentially a pre-built portfolio somebody designs, or a committee, or smart people basically put together and do the work for you. You will pay them a fee. You will pay them usually a relatively large commission, but you get instant diversification and an instant portfolio. So that's what it is. They don't beat the market. It's just the reality of the business. Most mutual funds, for whatever reason, don't beat the market. As many of them don't. So if you're asking the question, if they don't beat the market, can we just buy the market? Instead of picking 30 or 40 stocks out of the 500 S&P, or whatever the case is, what if we just bought those 500 stocks? You can do that. You can do this right now. You can go off Monday and purchase one share of every single stock of the S&P 500, or make it easier. The Dow Jones Industrial Index is also tracked very highly. There's 30 stocks in that. You can purchase every single stock in the Dow Jones. You can do that, and that's the market. Cool, you can do that. But there's an easier way to buy the market, and it's called an ETF. But not really a catch. So you're not trying to beat the market. That's if the mutual fund, the goal is to beat the market. If the market's up 10%, the fund should be up 20. That's a lot of performance, but 12, 13, 14% minus the fee. But you're not trying to beat it. You're trying to be it. So the S&P goes up 5%. The fund should also go up 5%. There's nothing fancy about this. Really isn't. So it's the market. So you could go out and, again, same thing, buy one share of all those stocks in the S&P, which you'll pay 500 commissions. That's times $10 to get in and out. That's a lot of commissions. It's about $5,000 in commission. If your account's $10,000, that's not going to work. So that's not feasible for most people, nor does it even make sense. But you could do it. Okay, well, same thing. You can buy one share of it's like a stock. It trades under the symbol SPY. Remember, McDonald's was MCD, Netflix was NFLX, etc. So just go out and type into your chart or your program SPY, which sounds sleuthy, but nonetheless, it's the spider, called the spider for the S&P 500. You'll pay one commission. You'll pay whatever your broker charges, $8, $10, $20, whatever you'll pay. It's a very small annual fee, not 2%, usually around 0.5%. Because somebody or some company is actually doing the management of these companies in the fund. They actually do put a fund together. So they do things, but they aren't picking, I'm not saying they have to be smart. That's not the right concept, but mutual funds are smart people. This is just basically rotating to what the S&P is. That's all they do. So you'll pay them about 0.5%. So that's not that much. If you want to beat or match the Dow Jones, which is 30 stocks, you'll just buy all of those stocks, pay 30 commissions, or buy one share of the symbol DIA. These are called diamonds, not that important, but DIA, purchase it, and you have the Dow Jones in your portfolio. Yeah, that's instant diversification. So you get McDonald's, you get Caterpillar, you get Microsoft, Intel, whatever you want to say in those 30 stocks, you get that in one transaction. So you buy them just as quickly, just as easily, just as efficiently as you would a share of a stock. You can do them at any point in time. When the market's open, you can do an ETF trade. It's just like a stock. They even pay dividends. That's really cool. It is the market. It's a pre-built portfolio full of stocks. It doesn't look like it, but it winds up being a portfolio of stocks built just for you and everybody else like you. You can do anything you want, buy and sell, even sell it short, which is a whole other concept, but you can do that, unlike mutual funds. And so we won't go through these, but there are they keep adding ETFs almost every week, certainly every single month. A company will come out, create a fund, an ETF at least, and will put it out there on the market. So just for quick, easy reference, if you want a biotechnology, you type in symbol IBB. What about retail? Things like Gap or clothing stores, those kind of things. Interesting. XRT for the retail ETF. Just value stocks, there's a fund for that. That's VTV. What about those growth stocks? That's IVW, etc. How about the financial stocks? You heard they'll be doing well, good profits, XLF. And the whole darn S&P, SPY. What about bond funds? What about how difficult it was to buy bonds? You can do that. It's not the same thing as a bond. Don't make the mistake of thinking a bond fund is a bond. It's not, but it approximates, it's close. 20-year Treasury bond, symbol TLT. And what about investment grade corporate bonds? LQD. So these are just to name a few. Segments of the market, and then bonds. There are international ETFs, there are currency ETFs, there are commodity ETFs, well beyond the preview of this conversation. But there are, if you can think about it, an ETF exists for it. Don't get caught up in that though. Don't get overwhelmed. You can stick with the SPY and be fine. You get instant diversification with the click of a button or a phone call if you desire, but it's easier on an app, on the Ameritrade or whatever, any type of thing, any type of broker that you use. Click a button and you get the ETF in your portfolio. You can focus your portfolio on a specific goal. You can laser target certain sections of the market, technology, etc. You will pay a small fee. That's fine, not a big deal. It shouldn't be, at least. You can trade these anytime, just like a stock, and you get all the benefits of a mutual fund without all the other headaches that come with it. But the bad thing is, I actually had to figure out what a bad thing was about ETFs. I really couldn't, honestly, except that there's just literally hundreds, if not thousands, to pick from. Just go with the SPY. That's the market. You'll be typically okay doing that. If the market does poorly, your ETF will do poorly too, but same thing with a mutual fund. So you don't want to do it yourself? No problem. Use an ETF. There's actually dozens or hundreds of ETFs, not just dozens. It's just as easy to buy or sell, and it's easier than building your own portfolio. Literally, you can go out right now. That's the goal of our course, right? To figure out how to empower you right now. Go out Monday, and markets close on Saturday, but on Monday or Tuesday, whatever the case may be, click a button and you have an instant portfolio right then, right there, right for you, and anybody else wants to do that. There are lots and lots of, you need to do your research. There are fees, there are commissions. You do research. Don't just go out and buy it, of course. Do your strategies. Learn about the things about them unique. And the websites exist, but one of which is ETFDB. It's one of my favorites. It's ETF Database. ETFDB Database. And that's just one. There's many of them. Yahoo Finance, all those have lists of ETFs. But again, if you're not a professional investor, you're just kind of doing a 401k or your portfolio, I would just say stick with SPY. It is the market. You won't beat the market, but you won't underperform it either. It is the market instantly. You can do that Monday.